Okay, sorry you'll be quite sick of me after being on the panel, so I'll try and keep this brief and to the point. No way venture capital. Sometimes that's the image of venture capitalists, is that we always look on the risk side of the equation. But as I'll try and explain today, there are some reasons for that. The first topic I was asked to cover, actually when Terrapin asked me to do this, I thought, please God, no mathematical questions. But first question cuts right to the heart of venture capital pricing and the capital asset pricing model, which is around risk-adjusted returns. I've got quite a lot of slides here, so I'm going to try and go through it quickly. I think it's worthwhile just quickly touching on why private companies are viewed so much more riskier than public companies. They're obviously less mature, they're smaller in size. The managers are often significant shareholders, where the public companies are more widely held. Possibly less quality and depth of management. Innovation and being an entrepreneur are great skills. It's no poor reflection, but obviously managing the business as it grows requires perhaps different skills of management and process and so forth. So in the case of a public company, you have more professionally hired managers for that process. You have a lower quality of information and disclosure. Obviously, you have regulations and public demand for more regular and accurate disclosure on the public side. Shareholders have a longer-term perspective, whereas the public market is more about short-term returns. Greater emphasis on tax management, or more importantly, reducing tax in the private sector context, where less emphasis in the public sector. Shares are less liquid, obviously, but we have a trading market on the public side. Concentration of control, but we have share ownership and control is more diffuse in the public market. And then potential restrictions on sale. Obviously, private company shares are more liquid, where we have a public market in the public company context. Keeping that in mind, obviously, the higher risk base of private companies, there are academically three main valuation approaches employed by venture capitalists. I'm only going to focus really on the income approach, because that's really involving cash flows, the discounting of those cash flows at a discount rate, where that discount rate tries to encompass all of the risks or the risk-adjusted returns that forms part of the analysis of that transaction. Usually there are three main methods, but principally people focus on free cash flow. I'm going to cover the capitalized cash flow approach as well, but I'm not going to go into any detail on the residual income. It's less commonly used, and really it's less tied to risk-adjusted returns. First thing you need to do is obviously look at normalized earnings of a company. Private companies often have a lot of related party transactions that are not arm's length. The brother is lending him a garage to develop the computer, or things like that. So you need to go through the financials and normalize those returns and bring uneconomic aspects of those to market. Then you can calculate the free cash flows. Typically, you can either look at it from an enterprise firm value, or you can look at it at a pure equity value perspective. All the academic aspect of it to one side, as a practitioner, typically we're always looking at the free cash flows of the firm, because we're valuing companies. When we're looking at discrete assets, like for example where you're acquiring like a real estate asset, where you have a special purpose company holding the assets, we might just look at equity returns in that particular context, where we've got a fixed level of financing and we have a fixed equity target return. I tried to come up with a sort of theoretical analysis that will try and flow through this presentation. This is just a waste-to-energy business that we might come across typically in Southeast Asia, where they're processing municipal solid waste to produce RDF, and they're selling that RDF. They're using some anaerobic digestion on the organic fraction and selling the remaining solid fraction as a fertilizer, and they have some other recyclables of metals. The income grows over time as that business stabilizes and matures, and we look at how we might value this business. At the heart of risk-adjusted returns is the capital asset pricing model. We have the standard capital asset pricing model, which has been around for, 20, 30 years. where we try and quantify risk as being the risk-free rate plus beta times a equity risk return. But there are also modifications of that that try to drill down into those individual risks and price those individual risks. A lot of this theory, to be honest, is more applicable in the public markets, and it's more of an art than a science on the venture capital side. But typically, we still need to do this analysis to provide support to the valuations that we do. Looking at the equity cost of capital, we first quantify what is the equity cost of capital, and then we put that into a model for weighted average cost of capital, which takes into account your cost of debt and your cost of equity. The equity risk capital cost is obviously the risk-free rate plus beta times a risk equity premium. And that leads us to how do we come up with the beta. Obviously, the beta is looking at how your particular target company valuation and profitability may vary or be volatile relative to an equity index. And so if you have a beta greater than 1, obviously your company is going to show greater volatility in the up and down cycle relative to the market index as opposed to a company with a lower beta. How do we calculate betas in a private company context is more difficult. We don't have a lot of publicly listed information as we have in the public sector. 3 main methods. One is accounting beta. You look at the accounts of the target company, but you only report infrequently, and then you try and match that to a sample of public companies in that same industry. Not all that effective because of the frequency issue. Fundamental beta, where you try and tie your beta to other measurable ratios of a company, debt to equity ratio, dividend ratio, all of these other types of ratios that you can measure. But again, there tends to be a pretty low correlation between that methodology and the index, and so there's questions as to reliability of that. The most common is a bottom-up beta calculation, where you look at comparable companies in the industry of the target company you're looking at. You calculate that beta, and then you look at what adjustments you need to make to that beta to make it directly relevant to your target company. In doing that, talking about these adjustments, when you derive the beta through a regression analysis from the public markets, you have to do 2 things after that. One is you have to re-leverage that beta, and we have a standard methodology for doing that here. And then secondly, which is something I guess a lot of people probably won't think about who come from a public market sector, is that we have to make a non-diversification adjustment. When we're looking at betas, we're always thinking about the marginal new investor into a transaction and what impact that would have on a diversified portfolio. But in a private company context, we don't have a diversified investor. Often the main shareholder is the owner of the company, and they may have all of their wealth invested in that company. So it isn't a diversified investment. And the way that's done is that we take the regression analysis of betas of the public companies, and we calculate the correlation coefficient of that, and we divide our beta by that. What that effectively does is typically it results in a higher beta, and that just reflects the incremental risk of not having a diversified portfolio. We then have 2 ways in which we can look at valuing this company. We calculate our free cash flows from the normalized income, and then we obviously have to think about a terminal value. One methodology is this capitalized cash flow method, and that's where you just look at the immediate 12 months cash flow of the business, and you divide it by the weighted average cost of capital minus a growth rate. This is a kind of return to perpetuity, and what's attractive about this is that it's a very easy and quick way to come up with a valuation. The downside, particularly in venture capital, is that often you don't have positive cash flows in your first few years. In fact, you could have negative cash flows. And so you'll come up with an anomaly if you take this valuation approach. Even still, once you've gone through that process of coming up with your value, you then also have to consider the effect of illiquidity. Private company stocks are illiquid, and so and there is a rule of thumb in the market that you might apply a 20 to 30% discount. But typically you want to look at a more detailed analysis of your target company and come up with your own methodology for how big or small a discount you should have. And you can look at the public markets to help derive that. But the key factors are, obviously, if the company is large and it has a lot of liquid assets on its balance sheet, then you'll have a lower liquidity discount than a smaller company with less liquid assets. Time, what is the market condition? If the market condition is, straight after Lehman's collapse, then obviously liquidity is at a premium and you would need to have a much higher liquidity discount. If the market is booming and there's lots of liquidity, then you have a less market. And then obviously buyers who have a long-term horizon versus short-term horizon would apply a different liquidity discount. And in the venture capital context, obviously the time horizon is often considered short relative to long-term investors. Taking that analysis before, what I've done here on the left is calculate the average beta from the market. I've calculated the R squared, which is measuring the correlation. I've taken the square root of that correlation to come up with the correlation coefficient, and I divide my derived beta by that. So that's just a long-winded way to say that the average beta for my industry, I'm saying, is 1.25, but once I adjust it for the correlation, I effectively double that beta, and that's going to effectively increase the risk premium. I then have to lever that beta. I use that to derive my cost of equity, and then from that I can derive my weighted average cost of capital. And so in this example, I have a cost of equity of 25.5%, and then I have a weighted average cost of capital of 17%. And obviously it's lower because it's a mixture of both the equity return requirement and the cost of debt. We then have our EBITDA, our leverage, our betas, our tax rates, our weighted average cost of capital, and we can just divide our free cash flows for the forward 12 months minus the tax effect divided by the weighted average cost of capital minus our growth rate, and we come up with a valuation. In this case, I'm coming up with 11 million. I think the point that's of relevance is that when I show you the next valuations is that no one methodology comes to the same valuation, and that this is more a process of triangulating different valuation methodologies to come up with what your concluded value is. The other method is you project your forward cash flows and then you come up with a terminal value for selling the company in the future, where you apply market multiples to come up with what that value of selling the company in the future might be. You can derive those multiples from companies that are trading in the market that have sold, or you can just look at the multiples of those companies that are listed today, but you then have to adjust those multiples for the private sector context. Sorts of adjustments that you need to make is you typically have to make a private company risk adjustment. If it's a strategic buyer, in fact, you might have a premium. If it's non-strategic investor, then you certainly wouldn't have a premium. In a venture capital context, primarily you're dealing with non-strategic investors. They're pure financial investors. Here I've taken those normalized earnings, I've calculated my future cash flows of the firm, and then over here where I have this 17.9 million value in the forward, what that is I've looked at the public company enterprise to EBITDA multiple. Everybody has different views. From my point of view for venture capital, we always want to look at cash flow multiples, not PE multiples. And in particular in Asia, where accounting methodologies can vary significantly, cash is always king. So we look at the enterprise value EBITDA multiple. I've put a private company adjustment of 18%. I come up with a 4.9 multiple, and I apply that to my EBITDA to come up with that. And then I discount all of these cash flows back at the weighted average cost of capital, deduct net debt, and now I'm coming up with a valuation of 9.2 relative to the 7 point something I had on my previous valuation. And this one is higher because I'm reflecting more of the growth of the cash flows going forward. And so really, depending on the stage of your business, one of these other two methodologies may be more appropriate. The next topic I'm going to cover is, the renewable energy sector in the context of venture capital. What are venture capitalists looking at today, and really, how are things going with venture capital in the renewable energy sector? What I want to first touch on is really what's happened in the last 12 months. And to be honest, the picture is not great. As you can see here, we're back in the heydays of just before the global financial crisis. We had about 10 billion US of global venture capital coming into the renewable energy sector, and in 2013 it's dropped all the way down to 2.2 billion. The big losers in this has been solar, and that's because of a number of historical failures for the venture capital market in the solar business in the early stages, as well as a perception of overcapacity in the market today. I'm going to sort of go through this quickly because I think there are some general themes that I really want to point out, but what this slide is trying to say is that really the downward cycle of venture capital in the last 12 months was really pretty much across the board. Bio, oils, solar, wind, all of these sectors were down. Actually wind was slightly up, but all other sectors were down. So it was more a reflection of the hangover that venture capital funds have had since the global financial crisis, the challenges they've had in raising new capital, and the fact that they've primarily been in an asset management mode dealing with legacy issues within their funds, that we now find ourselves in the situation of such a low level of venture capital investment in the sector. Another way to look at this is to look at the public sector, and that tells a very different story. The public sector is comparatively performing very, very well. Here we can see valuations have rocketed up from 2012, from 3.7 billion up to 11.1 billion, and then in terms of raising of new capital through the IPO markets, again, it was a boomer year in 2013. So public markets are performing well. If we look at the renewables index, we can see that it's performing as well, if not better, than both the S&P and the NASDAQ. Obviously, NASDAQ being more technology focused is a more appropriate sort of correlation to make, and we can see that the NEX has actually improved at a greater rate than the NASDAQ. And then when we look at the different types of renewable, it's pretty much been across the board. All renewable sectors have performed well. When we look at venture capital overall, again, it doesn't help the story because venture capital is up. We can see that there's a rising trend on venture capital investment, whereas obviously on the clean tech side, as we've said before, it's down. So really what we're seeing here is that venture capital have reallocated investment strategies and capital to other sectors away from the renewable sector in recent years. Looking at the winners and losers in this whole context, wind is up 71% in terms of venture capital investment, but then typically across the board, almost all other sectors have been down. Overall themes, which is really what we're sort of coming to, is that really venture capital is, in my opinion, starting to transition and look towards vertically integrated investment themes in a renewable energy context. So they're going to things like clean web, smart grid technology, power storage. These are things that are cut more to the fundamentals of venture capital, which is looking for high technology, early stage business propositions where there is the potential for rapid growth and returns. And obviously, based on biotech and software and other technology industries, venture capital are very comfortable in those sectors. And we're seeing things like clean web, technologies that are based around helping make initial assessment on rooftop solar merge in the US and perform extremely well in the public markets. These are sorts of sectors that are attracting venture capital. We also see increased interest in Zero-net building energy. This was a bit of a pipe dream in the past, but now we have many buildings that are getting to a zero-net energy. And there are many technologies associated with doing that. Again, they tend to be high technology focused, rapid growth return potential, and therefore they are strong targets for venture capital. In Asia, obviously with the economies developing rapidly, things like dealing with waste management streams, tends to fall behind, and so venture capital is finding its way into various solutions that are going into those aspects of the market. Solar and wind will obviously continue to be markets that attract investment, particularly once the venture capital groups recover from their legacy issues. And also it's been fueled by a very strong public market, as well as the fact that marginal costs for the implementation are coming down dramatically. And then the electric vehicle market. Obviously, the electric vehicle market in the public sense is performing extremely well, and there are many technologies associated with that, obviously batteries being one of them, and that's one area of certainly focus for venture capital. This last point is just to say that where venture capital funding has been down, a lot of that slack has been taken up by other groups, in particular corporate venture capital. We've seen a lot of activity from groups like SoftBank, GE, Schneider Electric, Johnson Controls and Siemens already, and we expect more activity going forward because these investors can be more strategic, they're longer term focused, they're more looking for synergies within their own businesses and the target companies, and in many ways they're more suited to the renewables market. There's also this phenomenon of yield cos, which has emerged in the US, which are kind of a quasi-private company pre-IPO listing vehicle, and this is attracting a lot of interest also. The next section is matching returns with investment strategies. To be honest, I really didn't know how to answer this in a venture capital context. And the reason is that, you know, when I look at venture capital versus all of the other capital providers, we've got venture capital, mezzanine or sub-debt type providers, buyout, private equity and distressed, and then we have a private equity context and a hedge fund context. Venture capital is almost exclusively a private equity. It's about as pure private equity as it gets. When we get to mezzanine and buyout, we have a lot more interaction with public markets. We have more participation, in fact, increasingly so by hedge funds in that space, not just private equity. And obviously on a distressed basis, we also have a lot of activity, particularly in the debt aspect of the capital structure from hedge funds, and then on the equity side from the private equity. So in the right-hand side of this diagram, there are a lot of different strategies, market dislocation strategies, arbitrage strategies, and the like. But when we're dealing with venture capital, in my view, the strategies are usually quite simple. You know, venture capitals are looking for young companies that have a high technology aspect to their business and have the capacity for rapid growth. Venture capitals have a limited time horizon to take a business from sometimes a concept stage to a listed public company, and so they have to invest in companies that are in industries that have the potential for that rapid growth. If that doesn't exist, then really it's not a market for venture capital. And this final point is that, you know, venture capital investing offers the potential for both huge gains and terrible losses. And I think no one in venture capital is in the business and has not experienced either one of those. One way that we might be able to look at strategy, if you like, versus returns is actually stage of investment. We have seed funding, startup, growth, second round, expansion stage, and then the VC exit or bridge funding. In this context, obviously, they tend to be grouped in things like early stage, growth stage, and late stage or exit stage. Obviously, as you come in at the early stages, the comparative risks are much higher. And then as you obviously come into a company in a more mature stage, then the risks are more manageable, and as a consequence, there's more competition for those opportunities, and the risk-adjusted returns are obviously consequently lower. Another point I sort of wanted to make is that venture capitalists are certainly return-focused, but in my opinion, it's often a binary type of decision. You know, would I go into an investment that has a really attractive return, but it has a lot of flaws in the investment thesis? It's not returns alone that will draw you into the investment. The investment needs to have certain core fundamental factors. Otherwise, it's a kind of go, no-go proposition. So this is an analysis that was done by someone much smarter than me around looking at venture capitalists and the investments that they have made and how they prioritize certain factors. Quality of management, size of market, product qualities, rate of market growth, competition, barriers to entry, company stage of development, and industry of the company. And these were the factors of their ratings. And obviously, quality of management was right at the very top. and then industry of the company was the least important of those factors. But then when you look at the spread between these factors, they are pretty much all important factors. So I think venture capitalists obviously look at returns, but they're evaluating transactions with this type of matrix to ensure that the potential for success in that business is certainly there. And then how they tend to be grouped is that we have sort of resource capabilities, which is, the management resource, the resource of the product qualities, and the company stage of development versus what are market type risks or market types assessments, size of market, rate of market growth, barriers to entry, and industry of the company. So venture capitalists look at returns, but it's not everything that is done. The probability of success is really driven more by these factors, and then the next stage is deciphering those deals that meet all these factors, but which price at a cost that delivers the sorts of returns that venture capitalists require. And then I think one other point I wanted to make is that I think, when people look at a return of an individual discrete transaction versus what is in a return that's provided by a venture capital fund and how it gets benchmarked against other funds, they often see a dislocation there. They might see a transaction price at a risk-adjusted return of 40, 50%, 10 times multiple of capital, and ask the question of how does that reconcile to the fund's performance of 22 or 23%. And as we've tried to indicate before, within a portfolio of venture capital investments, you're going to have winners and losers, and you need those winners to compensate for the losses that are incurred on those bets that effectively don't work. So that all comes into this methodology, but that is really the rationale behind why those returns are driven that way. Well, that's the end of the presentation. Sorry, it was a lot to cover. Is there any questions? Well, in that case, thank you very much for your time, and I hope you enjoy the rest of the conference.